The U.S. stock market is now collectively worth $30 trillion. It holds the accumulated retirement wealth of multiple generations, the hopeful investments of individual investors, and the portfolios of massive institutional powerhouses. About 40% of the stock market is owned by household investors who buy shares of individual companies. To own stock in a company is to own a piece of it, a share. Many investors are not active traders. They participate in the stock market in a more passive or even peripheral way by owning mutual funds or exchange-traded funds, ETFs, for investment vehicles like 401ks and IRAs. They may also invest in mutual funds, where the fund buys individual stocks and the investor buys shares in the fund. People often ask me, what is the stock market? A market is a place to buy and sell, and the stock market is no different, except that the quantities changing hands are sometimes massive, and that shares in companies and funds are primarily what's being exchanged. Going back to their origins, stock markets were physical buildings where stock trading took place, complete with frenzied running to place orders amid scattered confetti of ticker tape and deafening crowds of screaming traders. Most trades are done electronically now, allowing for a more efficient market, despite its growth over the years. We commonly refer to the stock market as though there's only one, but there are many stock markets that make up the overall U.S. stock market, sometimes called exchanges. Many of these exchanges have become household names themselves, such as the NASDAQ Exchange or the New York Stock Exchange, or NYSE, with its 2,400 traded companies representing about 2/3 of the total U.S. stock market by value. The other day, a friend asked me, "What is stock?" I told him that companies can be either public or private, and both types can have shares. But a public company has its shares publicly traded, usually on a stock market exchange. Public companies that aren't listed with an exchange are still traded, but they are traded either as OTCBB, over-the-counter, if they don't meet the listing requirements of the NASDAQ or the NYSE. For example, most penny stocks trade over-the-counter. The major source of over-the-counter penny stocks are the OTCQX, OTCQB, and Pink markets, owned by the OTC Markets Group, and the Over-the-Counter Bulletin Board, OTCBB, which is owned by FINRA. Companies that list on the OTCBB must register with the SEC. Securities that trade on the OTCQX, OTCQB, and Pink markets do not require SEC registration. A publicly traded company issues its first shares during an initial public offering, or IPO. The revenue from these shares is usually used for growth plans and other expenses. Growth in the number of shares after the IPO is often due to stock splits, which are a tool companies use to lower the per-share price without reducing the value of investors' holdings. If you had invested $5,000 in Apple at its IPO, you'd have over $2 million today, and you'd have over 50 shares for every one share you bought at the IPO, the latter due to stock splits. A share in a company is ownership in the company. However, owning a handful of shares doesn't earn a seat at the boardroom table. Apple, for example, has nearly 1 billion shares after beginning an aggressive buyback program that reduced the number of outstanding shares. Ownership may come with other benefits, however. Many companies pay a dividend on their shares. When the company does well and decides to fund its dividend, investors are paid a dividend for each share, allowing investors to benefit from any growth in the value of the stock, as well as earn a bit extra for their ownership. These dividends can be taken as cash or they can be reinvested. Most references to historical stock market performance include income from dividends as well as stock value appreciation. Another popular question people tend to ask me is, how does the stock market work? While extremely complex, it's easy to distill how the stock market works into a few steps. First, buyers place bids, and sellers offer asking prices for shares of stock. When the bid equals the ask, a trade occurs. The difference between what buyers will pay and sellers will accept is called a bid-ask spread. A smaller bid-ask spread indicates a more liquid security. A stock's price represents what the cumulative market of buyers and sellers decide the price is. It's all based on supply and demand. Let me ask you a question. What is an index? If you don't know yet, let me explain. Stock market indices are groupings of stock that share common traits or that meet the criteria to be included in the index. Indices can be based in part on market capitalization, which is the total value of all outstanding shares. Indices can vary in company type, ranging from a broad spectrum like the S&P 500 to indices heavily weighted in certain segments, such as the NASDAQ Composite Index, which has a strong representation of tech stocks. The larger indices serve as the bellwether to the overall stock market, often driving investor sentiment up or down with each exchange in the index's value. Most often, it's the Dow Industrial Index, made up of the 30 largest and most influential companies, and the S&P 500 that make headlines, demonstrating how an index can come to represent the broad market. Finally, someone who wants to be in the stock market will ask, what is a broker? If you want to buy a share of stock, or sell a share of a publicly traded company, you need a broker to help you complete the transaction. Stockbrokers are individuals or firms that execute buy or sell orders at your request. In exchange for executing your trades, the broker collects a commission or a fee. Brokers can be either discount brokers or full-service brokers, with each type catering to a different type of trading. A discount broker executes trades inexpensively, typically charging between $5 and $15 per trade, but usually doesn't provide personalized guidance for its least expensive trading services. Full-service brokers offer a more comprehensive variety of services, including investment advice. The higher level of service provided by a full-service broker usually means higher fees. Before the advent of discount brokers, stock trading was largely a pursuit for more affluent investors who could afford a full-service broker. The internet can be credited with changing that paradigm, making stock trading easily accessible to anyone with an internet connection and a desire to invest. As you begin to learn about stock market investing, you'll encounter the terms bid and ask. The bid is the price a buyer is willing to pay for a stock, while the ask is the price at which a seller is willing to sell. If you want to buy a stock for $10, you can place that order with your broker to buy a fixed number of shares at that price. However, if nobody is willing to sell for that price, the trade won't be executed. There is also the option to buy or sell at market price, which usually results in a faster transaction. Investing is an excellent way to grow wealth, in both periods of market volatility and while the stock market is smooth sailing. The best way for beginners to get started investing in the stock market is to put money in an online investment account to buy shares of stock or stock mutual funds. Many online brokers let you start investing for the price of a single share. In smaller markets like OTC trading, a market maker helps to facilitate trades by buying shares offered for sale and then posting those shares for sale again. This is particularly useful when the spread between the bid and ask is wide and a stock is thinly traded, meaning there aren't many buyers or sellers. To understand the stock market, it's important that you can read and analyze stocks. There are a number of ways to do this. Some people are more comfortable doing all their own research and analyzing stocks independently. Others might like to have the help of a stock advisor. So, which way is the best way? There are 5 ways to analyze a stock. Number 1. P/E ratio. A P/E ratio is short for a price-to-earnings ratio. This is a commonly used method to analyze stocks. You can determine the P/E ratio of a stock by using a simple math division. To find the stock's P/E ratio, you divide its market value per share by its earnings per share. You'll use this ratio to help you determine how valuable the stock is. Once you know the stock's P/E, you can compare it to the stock's competitors. Typically, the lower a price-to-earning ratio is, the more valuable the stock is. Number 2. Earnings per share. You can also analyze a stock by looking at its earnings per share. You may also see this referred to as a stock's EPS. This will give you an idea of how much the company is earning and whether investors are benefiting from that. If a company's EPS is growing, that can be a good sign. Most investors will become interested in purchasing stock in a company when it is earning good money. Generally speaking, the higher a company's earnings per share is, the more those shares are worth. Number 3. PEG value. The PEG value stands for the price-to-earnings growth ratio. This ratio is similar to the P/E ratio because it also compares a stock's market value to its earnings per share. The PEG adds another factor by considering the company's growth. To calculate a stock's PEG value, you'll need to know the P/E ratio and the 12-month growth rate of the company. Using the company's growth rate over the past years, you can estimate the company's growth rate in the future. In most cases, look for a stock that has a PEG value lower than 1. Number 4. Book value. Another way to analyze stocks is using information to find undervalued companies that have experienced a lot of growth. To find these companies, you will want to use a price-to-book ratio. This may also be referred to as a PB ratio. Before you calculate the PB ratio, you will need to know the company's book value of equity. You can find this by subtracting the book value of a company's assets by its book value of liabilities. Once you know this, you can calculate the price-to-book ratio. To find the ratio, divide the market price of a company's stock by the book value of equity. Number 5. Debt to Ebitda. This is another ratio that can help you determine and rank the value of a stock. Ebitda stands for Earnings Before Interest, Tax, Depreciation, and Amortization. It is used to evaluate the performance and value of a company. The debt-to-Ebitda ratio is used to measure the ability of a company to pay off its debt. If your calculation shows a high debt-to-Ebitda ratio, it may mean that the company is carrying too much debt and could be in trouble. If you really are into stocks, instead of going through the ratios yourself to figure out which stocks to invest in, you might decide to seek out recommendations. There are a number of reputable sources online that can help give you an overview of the stock market. These sources can recommend valuable stocks to invest in and help you understand the stock market better overall. Stock terminals can be a good option. Stock terminals are computer systems that allow you to access real-time financial data. Many people refer to the Bloomberg Terminal when talking about stock terminals. The Bloomberg Terminal has been around since the 1980s, and it has built up quite a reputation over time. It allows users to not only monitor real-time financial data, but also offers the ability to access breaking news and place trades. The Bloomberg Terminal is quite costly, however, and you can expect to pay between $20,000 to $25,000 per year for this access. Another more cost-efficient option is to enroll in a subscription service. Many of these subscription services are with stock advisors. The benefit of enrolling in this is that it can give you advice as well as information about the stock market. If you decide to analyze stocks yourself or use a stock terminal, you are left to make your own conclusions about which stocks are valuable. Enrolling in a stock advisor subscription program can help you make quick decisions about which stocks to invest in. Morningstar's service offers another perspective. It focuses on investments that produce consistent returns more than it does on using technical charts to predict stock value. It offers an analysis of stocks, mutual funds, and exchange-traded funds, or ETFs. Morningstar also provides the pros and cons for all investments. You can use this research to compare investments to each other and see how the investment has performed over time. Morningstar also offers a stock and mutual fund screener that allows you to find investments by searching hundreds of key data points. Finally, if you're just starting and don't have much money to spend on these subscriptions, consider subscribing to my YouTube channel. It's free. The stock market can be a confusing place. There are a number of options you can choose from when it comes to determining which investments are right for you. You can use the ratios provided in this video to analyze stocks for yourself. You might decide that using a stock terminal like BZ Pro would be beneficial for you. A subscription service might also work out well for you if you'd like to receive more pointed advice to help you make your investment decisions. Ultimately, the best way to analyze stocks is the one that works for you. Consider your options and decide how comfortable you are with navigating the stock market on your own. Compare services to figure out which one works best for your budget and investment goals. You might have some money to start investing in stocks, but after hour upon hour of staring at your laptop, researching, and ultimately getting frustrated, don't worry, we've all been there. There's a lot of conflicting information out there and a zillion investing tools. It gets overwhelming. Before you buy your first stock, you should definitely understand the following: what a stock is, why people buy stocks, how to buy stocks, and where you can do market research. Then assess your goals, figure out what stocks are best for you, and make your first purchase. Stocks are simply shares of a company that can be purchased and sold by investors. Publicly traded companies sell shares to the general public, and when a person purchases one or more of these shares, that person becomes entitled to a proportional piece of the profits generated by the company. Oftentimes, these profits will be paid out as dividends or will be reinvested into the company in order to further increase its profits. As investing in stocks offers immense opportunities for profit, there are many reasons one might choose to begin trading. Most people don't envision themselves working into their old age, so many employers offer opportunities to invest in a 401k or Roth IRA, which can offer benefits such as tax advantages related to the treatment of capital gains and dividends. Additionally, many employers will match a portion of your contribution to your 401k to help build your retirement fund faster. If you're interested in learning more about where you can save for retirement, visit our Best Roth IRA Accounts and Best IRA Accounts for more. While many individuals trade stocks as a way to produce a second income, others make their living entirely from investing and trading stocks and build substantial wealth. Additionally, taxes on long-term capital gains and dividends may be lower than the applicable income tax rate. Investing can also be a great way to pay for school. Prepaid tuition plans, education savings plans, and 529 college savings accounts allow investors to open accounts and save for future education expenses by investing in select stock instruments. These plans are generally sponsored by state governments and can be used to pay for all fees related to higher education. If you already have enough money to support all of your needs, you may be interested in stocks to create an inheritance to leave to your family. When your heirs inherit your stock, they can reset their cost basis and potentially rid themselves of capital gains tax liability. Profits from stock can be a great way to generate money to donate to charity. When you donate stocks to charities, you'll often be able to increase your contribution while experiencing significant tax deductions. Furthermore, if you donate stock rather than selling and donating cash, you can avoid capital gains taxes. Now that you have a hold on typical investing goals, you might want to venture into the different types of stocks. Domestic stocks are simply stocks of American companies that can be purchased and sold on the various American exchanges, like NASDAQ or the New York Stock Exchange, or NYSE. Domestic stocks can be divided into common stocks and preferred stocks. Preferred stocks require that preferred shareholders be paid before common stockholders, and typically have higher and more consistent dividend payments, but a lack of voting rights and capital appreciation. There are also convertible stocks, which act as preferred stocks, but can transition between common and preferred stocks under certain conditions. Foreign stocks are simply stocks of foreign companies that are traded on foreign exchanges. For example, Nintendo, while very popular in the United States, is a Japanese company which is traded on the Tokyo Stock Exchange. These stocks can still be purchased by American investors, but require a broker that is authorized to trade on foreign exchanges. These companies may be listed under American Depository Receipts, or ADR, which trade like a stock and is issued by a bank representing a certain amount of shares in that company. Exchange-traded funds, or ETFs, are traded on stock exchanges just like a common stock. However, they do not represent shares of a company. Instead, ETFs are marketable securities which hold assets such as bonds, commodities, and currencies that are typically tied to an index. ETFs are extremely attractive to some investors for their low prices and opportunities for profit. Just like ETFs, ETNs are traded on major stock exchanges and behave similarly to common stocks. ETNs, or exchange-traded notes, are unsecured debt securities which are issued by banks and are linked to an index. Before you buy, think about your investing goals. Consider the following. Is your goal long-term or short-term? What's the exact time horizon? How much risk can you handle? How do you want your assets allocated? Once you know, take a look at some popular stocks, their performance, and assess. Of course, you may need help with this. Don't be afraid to call a financial advisor, a trusted friend, or a brokerage to assist you. Find a company that you're interested in investing in. Picking a stock can be difficult, as it can be hard to predict how a stock will behave in the future. Making an investment can be tricky. You could lose a portion of the money that you put in, so you should be thoughtful in this decision. Investing in stocks comes in the form of trading and investing. Traders typically only hold stocks for short periods of time and are less concerned about the long-term fundamentals of a company. Investors look towards a longer time frame and consider how the company will perform now and in the future. Regardless of which path you choose, it's important to do your homework and learn as much as possible. Whether you're selling stock you've invested in or want to initiate a bearish short position as a trader, there are many different reasons to sell a stock. While some traders might watch corporate insiders to see when they sell their company's stock, the most common reason individuals sell their stock is that they need the money they've invested. How to sell stocks, in a nutshell. Decide whether you're a trader or investor. This comes down to how long you plan on holding on to your stock. You want to pick a style of selling that matches your financial goals. Use an online broker. Online brokers make it easy and convenient to sell your stocks. Test out the trading platform. Make sure the broker you select allows you to trade how you want. If you're going to be day trading, pick a broker known for speed. If you're a beginner, start with a broker with great resources and educational tools. Make your sale. Use your brokerage to set your sale price and begin selling your stock. You can simply enter a market order with a stockbroker and sell your stock. This is done at the current market price if you need to sell for the money, and you don't have to consider much else. On the other hand, if you want to sell your stock to buy another stock, or if you want to trade one stock in order to make an investment in another stock, there are several things to consider. First, think about your planned trading or investment horizon, which sets out the average time you plan to hold stock. Are you a trader or an investor? Both types of market participants buy and sell stock, but they have different ways of achieving the same goal of overall profitability. For example, a day trader will have a much different time frame and criteria for selling stock than a long-term investor, so make sure your stock selling activity is part of your overall trading or investment strategy. Before you sell your stock, consider your reasons for selling it. Be sure you're not acting on impulse because of an adverse market move, especially if you'll incur a loss. Remind yourself of the reasons you purchased the stock in the first place. Be patient and try and research why the adverse move occurred. Remember, you buy stocks to make money, not to take losses. If you actively trade short-term strategies, your main reasons for selling stock will be to take a quick profit or a smaller loss. You might also sell your stock because market fundamentals indicate a looming recession, especially if they're invested in cyclical stocks that stand a good chance of showing a future price drop. You might also sell stock because you follow the company's current situation and future outlook. From here, you can tell the prospects for the company's industry, including whether the company's stock stops paying or reduces the amount of its dividend. Each industry is exposed to different fundamental risks. For example, automobile companies might need to do a costly recall that would severely cut into earnings. Electric utilities may be liable for disasters, such as Pacific Gas and Electric, found liable for the deadly Camp Fire in Northern California in 2018. When news like this breaks, it can be a good fundamental reason for selling your stock in the affected company, since its price is likely to decline quickly. The order types for selling stocks are pretty straightforward and are in line with how the market works. Traders use different order types to limit their buying price, maximize their selling price, and limit losses. Market sell order. This type of order allows you to sell the stock immediately, and it guarantees that the order will be executed without specifying the price of execution. Market orders typically get filled at or near the bid price when selling stock, just as they are filled near the offer price when buying. Keep in mind that the last sale price, which is generally displayed on a screen or stock ticker, may not be the price you'll get when you trade using a market order. Limit stop order. This is a type of order to sell stock at your specified price or better, which is what the word limit refers to. Sell stop order or stop loss sell order. A sell stop order triggers an execution once the stock reaches a certain price below the prevailing market, known as the stop price. Upon the market reaching and trading at the stop price, the sell stop order then becomes a market order to sell the stock at the best available price. Trailing sell stop order. When you look at a profit on a long stock position and have placed a protective sell stop order to avoid taking more of a loss, you can also protect your profits by using a trailing sell stop order. This order is similar to a stop order, but its price is automatically moved up according to the parameters you specify as the market continues to rally, thereby improving the sale price you get if executed. In addition to the type of order you have entered to sell stock, you can also put a contingency on your order. All or none, or AON. This contingency specifies that the sell order must be filled in its entirety or not at all. Partial execution cannot take place on an AON order. Immediate or cancel, or IOC. An immediate or cancel order gets canceled if not immediately executed, although the order can be partially executed. Fill or kill, FOK. A fill or kill order combines an IOC with an AON. The order must be filled in its entirety immediately or the order is canceled. Day order. Unless otherwise specified, a limit or stop order to buy or sell stock is good only for the day it was placed. This means it is a day order. Good till canceled, or GTC. This type of order stays on the book until the order is canceled or executed, regardless of the day it was entered on. Market on close, or MOC. Generally, this is a limit order held by the broker throughout the trading day, but if the market fails to reach the desired level by the close, it then becomes a market order to be executed at the market close or shortly thereafter. Market on open, or MOO. A market order used to buy or sell stock at the prevailing market on the opening bell or as soon as possible thereafter. A couple of additional methods of selling stock exist that are mostly used by traders for speculative purposes. These consist of short selling and buying put options. Different types of trading strategies may call for selling stock before it has first been purchased, which is also called selling short. In order to sell short, your broker must be able to borrow the stock for you to sell. After selling short to express a bearish view on the market, you'll ideally buy the stock back after the price has declined. The profit from a short sale consists of the difference between the sale price and the price where the trader covered the short sale by buying back the stock previously sold. This works in reverse as well, since if the stock price goes up after it is sold, then the trader loses the difference between the price he sold the stock at and the higher price he paid to cover his short sale. Selling stock short also requires that your broker have the ability to borrow the stock and will allow you to make this type of trade. Selling short can even cost considerably more than just buying on margin, so if you're thinking of selling stock short, then you'll need to put up some money to meet your broker's requirements. A broker will also charge a stock loan fee that can range between 2.5% and 100% of the value of the stock shorted, depending on the broker's difficulty in borrowing the stock. In the United States, the borrow rate for borrowing U.S. stocks to sell short is set by the Federal Reserve Board's Regulation T, that requires an account to have 150% of the stock's value available as margin at the time of the short sale. For example, if you wanted to short 1,000 shares of a $10 stock, you would need $15,000 in your margin account in order to meet the Reg T requirement. Note that certain rules may exist for short-selling stocks to protect against stock market crashes, such as the quick rule that was used in the U.S. stock markets from 1938 until its removal in 2007. This type of rule usually states that in order to sell stock short, the price has to be at a higher price than the previous trade-in stock or at an uptick. Since the global financial crisis hit in 2008 shortly after the original uptick rule was eliminated, the alternative uptick rule, SEC Rule 201, went into effect in 2010. This new circuit breaker rule now prohibits short sales for 2 days after a stock declines over 10% of its value compared with the prior trading day. Another way to sell stock is by purchasing a put option on the stock. The advantage of buying puts is that they cost a fraction of the amount you would be required to put up to short stock, and that cost is called the options premium. A put option gives the holder of the option the right, but not the obligation, to sell a given number of shares of stock at a certain price, known as the strike price. The option contract lasts until a particular date and time known as its expiration, at which point the option needs to be exercised or abandoned, depending on whether the prevailing market is better or worse than its strike price. Also, if you own stock already and buy puts to combine with your long stock position, you have essentially insured or hedged your stock investment below the option strike price. If your stock then continues to appreciate, your put option would expire worthlessly, but you can still participate in the upside movement of the stock. If your stock's price instead declines substantially, your put option might end up in the money, so you would then need to either exercise or sell your put on or before its expiration. If your stock is already in a stockbroker account, then you should be able to sell the stock directly from your account. If you own a stock but do not have a stockbroker, then you probably have physical stock certificates in your possession. In order to sell stocks in certificate form, you must take them to a licensed broker or dealer to sell for you. Keep in mind that how you sell your stock is just as important as where you trade, so make sure you pick the best online broker for your needs. The right broker means the broker that best meets your requirements. Check out a few of my favorites in the description. The broker you select to sell your stock will most likely offer a virtual or demo account. This gives you the opportunity to assess the broker's trading platform and stock execution service. Ideally, you should open more than one practice account so that you can better determine which broker best suits your needs. Using a practice account can also help you improve your trading and investing skills. Once you've determined which broker best suits your needs after trading in a virtual account, you can then use either the stock you own or a margin deposit to open a trading account. The value of the stock you deposit may suffice to open an account, although some firms may require more of an initial deposit than you have in stock. If this is the case, then you would have to deposit additional funds into the account, as well as any stock you plan to sell. After you have transferred your stock into a trading account, you can then choose a price level and place a sell order for your stock, or just sell it at the market. Depending on the price you wish to obtain for your stock sale, you can either enter day orders every day until you sell your stock, or you can enter a GTC order. Selling stock doesn't have to be complicated. You just need to have stock in an account or be able to borrow it and know at what price you wish to sell and the type of order and contingencies to place on the order. Selling stock is most often done to liquidate an existing long position, but short selling has proven to be an extremely profitable strategy in downtrending or correcting markets. Also, the purchase of put options combined with a stock position can provide a hedge in uncertain markets over a given time frame. Have you always wanted to dive deep into the details of predicting how a stock might perform? Always wondered how the broader market impacts a stock over time? The best stock charts are instrumental in helping you learn the ropes. Think of a stock chart as similar to a patient's chart at a doctor's office. The best way to make a diagnosis is to look at a medical chart to see the history, symptoms, and other unique factors about a patient. Similarly, stock charts allow you to put a magnifying glass to the inner workings of the market so you can understand how a stock might behave. Tag along, and we'll show you how stocks work. It's imperative that you learn how to read a chart, just like a good doctor pores over a patient's chart to do some detective work. Stock charts burst with technical indicators, and wrangling that amount of information is like wrangling everything there is to know in all the best stock trading software. The basics can be mastered, luckily. Indicators do way more than tell you how a stock trades at a specific point in time. Stock charts help you determine what a stock might do and can guide you so you'll know whether to buy, sell, or hold. You can learn how to analyze chart patterns and flush out uptrends, downtrends, whether a stock is trading sideways, or even give you details about the company as a whole. What happens if you don't use stock charts? A stock chart can help you the way blinders help a horse, or the way a map helps you know where you're going as you drive from Maine to California. Not using a stock chart might mean that you'll run off course, as you can imagine. Like a map, a stock chart can help you see what's happening with a particular stock and can help you drill into what's important. Stock charts enable you to do some detective work on price changes, historical highs and lows, dividends, trading volume, and other vital information. You only want to buy a stock when it's already moving in the right direction, up. There's no clear trend when a stock trades sideways, and of course, when it's heading south, you'll want to avoid it altogether. Stock charts are a little more than a bit of fancy detective work. They can tell you whether a stock is being bought or sold in large quantities through the purchase actions of fund managers and other institutional investors. All stock charts display price and volume, and these are two critical components of a stock chart. Stock chart volume is the number of shares traded during a given time period. Stock volume is a measure of the number of stock shares that have been exchanged or traded within a specific period of time. Volume is usually plotted horizontally as a histogram along the bottom of the stock chart. It can also be plotted right on top of the prices. The stock price on a stock chart reflects the current trading price of a stock. Together, both stock price and volume can tip you toward noticeable cues so you know what to do with your stock. Volume and price are only valuable when you combine the two factors, and one of the keys to checking the price and volume action of a particular stock is to look for unusual spikes in the stock you're investigating. Support is a price level where a stock will stop moving downward depending on demand. As the price of assets or securities drops, demand for the shares increases and forms the support line. Meanwhile, resistance zones arise due to a sell-off when prices increase. Think of it as a floor of support or a ceiling of resistance. A stock might pull back, and you'd want to see if it finds support at key areas, such as in a moving average line, the average price of a security during a specific time period. For example, a 200-day moving average looks back in time and averages the price over the last 200 trading days. A 50-day moving average does the same over 50 days. These indicators are often used to find buying or selling signals. As the price drops and approaches support, buyers, demand, become more inclined to buy, and sellers, supply, become less willing to sell. A stock finds support when large investors buy up a particular stock. You might want to hold or add shares to your position when you see evidence of many investors buying a particular stock because it shows that fund managers are buying shares. On the other hand, a stock might not find that support and could burst through a moving average. That's an excellent sell signal because it shows that fund managers have gotten rid of shares. The basic chart types can offer valuable information. Bar charts include the high, low, and closing of the day or week to chart a trend. Bar charts give traders a better idea of how the stock traded throughout the day, and it specifically shows daily volatility. You'll see open, high, low, and close that determine the price plot for each period of a bar chart. You can also see the high and low on the top and bottom of the bar, which are represented by a horizontal dash. A line chart is the simplest chart because it only requires you to have the stock's last price. Candlestick charts show when the stock closed higher, bearish, or when it closed lower, bullish, using different colored candlestick figures. According to Fidelity's description, traditional candlesticks offer a hollow, white or green, body to indicate an up day in that day's price action. You'll see a closed, black or red, if the close is lower than the open to indicate a down day. A single vertical line shows the high and low, which are called the wicks or shadows. Point and figure charts only look at price changes, no volumes or dates, and use a series of X and O figures to make up the chart. If you're ready to learn how to read a stock chart, here are some basic steps to get you started. Step 1. Choose a stock to observe. Determine which stock you'd like to track. You might have a stock already in mind, or you might want to compare a few different stocks. Arm yourself with the ticker symbol, also called a stock symbol. The ticker symbol is an abbreviation that's used to identify publicly traded shares of a stock. Each ticker symbol is unique and contains a mixture of letters, numbers, or a combination of both. For example, Apple's ticker symbol is AAPL on the New York Stock Exchange, or NICE. Step 2. Check out price and time. Price and time can be found on the two axes of a stock chart. Time is located at the bottom of the stock chart, on the horizontal axis, and the price of the stock is found on the side of the chart, on the vertical axis. You usually have a lot of options to determine the time period you want a stock chart to reflect. Prices are plotted from left to right across the x-axis, and the most recent plot is on the far right side of the chart. The time and price axes are the key to helping you see where the trend lines fall, which will help you determine what's in store for the stock you've chosen. Step 3. Assess the trend lines. Check to see where the trend line is, well, trending. Is it moving up, down, or sideways? Make sure the trend line doesn't pass through any prices. You should be able to draw the trend line underneath the lows if the price rises. Conversely, you'll draw the trend line above the price highs if the price is falling. The majority of prices should be contained above or below the trend line. At this point, you'll look to see where the trend line changes. A sharp rise or fall in prices is most often caused by unusually high trading volume that will return to its normal level. For example, a trend line above a 45-degree angle is more likely to correct. On the other hand, an angle between 30 and 45 degrees is more likely to hold. It's a good idea to avoid anything below a 30-degree line because that's most likely headed into negative territory. Step 4. Note patterns and determine an outcome. Look for spikes in trading volume, recent highs, and recent lows. Get used to seeing patterns and apply indicators to charts so you think you'll be able to better predict how a stock performs. Apply support, resistance, and trend line drawings to identify trading opportunities. Once you become more comfortable reading stock charts, it'll become easier to determine specific patterns. The more adept you become, the more you'll be able to make money off the stocks you trade. If you don't have $10,000 readily available to invest but have $200 instead, believe it or not, your money could grow to $10,000 in no time. If you invest $200 monthly at an interest rate of 3%, it will become $10,000 in just 48 months. An investment of $200 per month can mean giving up a serious cigarette habit, canceling premium TV channels, or taking the bus instead of paying for parking. When $10,000 is available for investment, it's time to consider the time value of money. First, consider today versus tomorrow. You might be able to pay the rent for 6 months with $10,000, buy a 4-season wardrobe complete with shoes and outerwear, or buy a year's supply of food, with tips included. However, $10,000 invested today could mean a home in the future, a child's college education, or a secure retirement. A young investor with $10,000 in a retirement fund today could end up with a $1 million retirement fund in 40 years. A 5% down payment on a $200,000 home is also $10,000. Assets that depreciate are not investments. A car is a great example, whereas an asset that appreciates, a house, is an investment. The more assured the potential appreciation, the more the asset fits the definition of investment. Insurance is not an investment. Insurance is necessary to prevent unexpected loss. Auto, health, and home insurance are not investments. Neither are annuities or life insurance. Insurance is a cost that is added to an investment that limits the return available from that investment. Now, consider time and timing. Investing the same amount on a regular basis is called dollar cost averaging. The advantage of dollar cost averaging is that regular deposits of static dollar amounts buy into the market over time through its ups and downs. The same amount buys fewer shares of a company when the market is high, but when the market is low, the investment buys more shares at bargain prices. Dollar cost averaging also insulates the investor against market volatility by spreading purchases out over a period of time. If your $10,000 is put into work now, not later, the question becomes where to put all that money today. If a goal or purpose has a time schedule attached to it, then how you invest is adjusted toward more conservative selections. Investing for 30 years in the future is very different than investing for only a year or two. An investor with a 30-year time frame can buy the Vanguard 500 Index Fund investor shares, symbol VFINX, or the Pure Growth shares of Berkshire Hathaway, symbol BRK.B. A 1 to 2 year time frame allows for only no-loss investments, such as U.S. Treasury bills or bank certificates of deposit, CDs. Investments of 2 to 5 years are a difficult balance of risk and time frame. Decide if you want to loan or own. There are two ways to invest in securities of major companies: bonds and stocks. A bond represents a guaranteed income paid in regular intervals to the bondholder for a certain period of time. The bond matures at the end of the time period, and the bondholder receives the par value, or $1,000. Bond buyers make loans to the bond issuer for a certain rate of interest over a certain period of time. The bond buyer becomes the lender, just as the bank lends via mortgage to a home buyer. The U.S. Treasury Department pays $28.75 per $1,000 on a 10-year bond, which trades for $978. So the bond's yield to maturity is 3.13%. Bonds can also be used for speculation. If Tesla, symbol TSLA, seems too volatile, you might consider investing in the bonds of the same company. Tesla's 5.3% bonds that mature August 15, 2025, are now trading for $843 per $1,000. That would produce a yield to maturity of 7.59%. But if Tesla turns a profit in the next 2 years, the Tesla 5.3% bond could easily trade where it was issued at $1,000 per bond. The Tesla bondholder would have a 19% capital gain plus the interest payments received along the way. The problem with investing in bonds for a 2 to 5 year time frame is that the longer the bond, the higher the yield, but also the higher interest rate risk. The price of a long bond will drop as interest rates rise and the investor's bond portfolio will shrink in value. A safer way to buy bonds and prepare for changing interest rates is known as a bond ladder. A bond ladder builder buys government bonds or bank certificates of deposits, CDs, in equal amounts over regularly spaced maturities. $10,000 invested in a short-term bond ladder would buy $2,000 of fixed income securities in each of 5 different maturities. When, after 1 year, the shortest bond purchase comes due, or matures, then the redeemed funds from that bond are used to purchase a long bond. Over the years, the portfolio will hold long bonds with the highest rate of interest, but with 1/5 of the portfolio liquidating every year. If interest rates rise, the investor buys the higher rates every year. If the interest rates fall, the portfolio holds the higher interest rates of the past. The cost of managing the portfolio, assuming a 1% commission on one bond purchase per year, is 0.2% of the total assets involved. That is less than any actively managed mutual fund. Common stocks of publicly traded companies consistently outperform other types of investments over the long term, but managing a stock portfolio with a 2 to 5 year time frame demands higher quality investments that provide dividend income. As the bond ladder simplifies fixed income investing, a fixed portfolio strategy also simplifies stock investing. The dogs of the Dow and the Dow 5 are portfolios of stocks selected from the 30 stocks that make up the Dow Jones Industrial Average, symbol DJIA. The 30 stocks that compose the DJIA are first-ranked dividend yield. The dogs of the Dow are the 10 Dow stocks with the highest yields. Managing a dogs portfolio involves rebalancing once per year. On the anniversary of the establishment of a dogs portfolio, the investor again certifies the 10 highest-yielding stocks in the DJIA, sells those stocks that are no longer members, and buys the new stocks. Those that are sold likely provide profits because stock prices rise and dividend yields drop. The Dow 5, also known as the small dogs of the Dow strategy, takes the selection process a step further by choosing only those 5 lowest-priced stocks of the 10 highest-yielding. The Dow 5 strategy has outperformed the dogs-only strategy. The stocks are held for 1 year, and then those that are no longer the lowest prices are sold at profits and replaced with their next year's substitutes. An independent-minded investor might want to proceed cautiously at first in order to learn all there is to know from each new experience before proceeding to the next. $100,000 is a life-changing amount of money. No matter if you've worked for it, inherited it, or won it in the lottery, making smart investments now can help you set up a healthier financial future for yourself and your family and grow your money exponentially over time. Before you spend, determine your risk tolerance and consider placing your money into one of these 4 smart investments. Your risk tolerance is the level of tolerance you can withstand when it comes to seeing returns on your money. If you have a high risk tolerance, small returns are not the end of the world, and you won't be in serious trouble should you lose all your money. Those with high risk tolerance can afford to risk more and venture to see larger returns. On the other hand, if you have a low risk tolerance, you need to see returns or you will experience immediate negative life consequences. Some of the factors that contribute to your unique risk tolerance level include Life comes with surprises, and many of them can be expensive. From a sudden job loss to an unexpected surgery, keeping an emergency fund robust enough to cover 6 months' worth of expenses can help protect you and your family from debt in the event of an unfortunate surprise. If you don't yet have an emergency fund in your budget planning or your emergency fund is weak, put some of your money into a nest egg before you invest. Younger investors have the benefit of time on their side. With more years until retirement, they can afford to be riskier with their money and make more mistakes because compounding interest can make up for dips in the market or poor returns in the long term. Older investors will want to look for more guaranteed returns, especially if they are a year or two from retirement. Do you know how much money will be in your next paycheck? If you're in a salaried position, settled, with a family, and not planning on making a career change anytime soon, you can afford to take more risks with your money because your income stream is predictable. On the other hand, if you are self-employed or work only part-time, your income varies. You'll want to make more secure investments. Least risky. Pay off your debts and mortgage. From student loan debt to credit card debt, paying back what you owe should be the first thing you do with your money if you're looking for a secure investment. Debt accrues interest, can lower your credit score, and can also cause unnecessary stress in your home. Paying down your smallest account first and working up to your largest debt, likely to be your mortgage if you own a home, is a completely risk-free investment that will put you in a better position to invest your leftover funds. There is one caveat to paying off your mortgage. If you have what's called a prepayment penalty written into the terms of your mortgage, you will face a fee if you pay off the mortgage before the completion of the original terms. Prepayment penalties are less common today than they once were, and typically only apply if the homeowner pays off the mortgage within 2 to 5 years of the start of the loan. Mild risk. Invest in high investment index funds. Most IRA providers draw in younger investors with low minimum index funds, but may also offer high minimum investment funds that cut expenses in exchange for a certain deposit. For example, Vanguard's Admiral shares function almost identically to its matching normal index funds, but require a minimum investment of $10,000 to $100,000 for actively managed funds. In exchange for the high minimum, the company lowers the expense ratio by about 40% for most Admiral-level funds. Think of high investment index funds as a sort of elite club for the most prominent investors. Index fund investing is a low-risk investment option. Though any stock market venture comes along with an inherent level of risk, index funds are able to mitigate this through portfolio diversification. Moderate risk. Start currency trading. Currency trading, or forex trading, is the process of buying and selling the currencies of other countries. Most forex traders use an investment process called buying on the margin to see profitable currency trades because the value of currency usually varies by only a few cents per day. When you buy on the margin, you put a sort of down payment into your account, and your broker extends leverage to you as a ratio. For example, if you have a 100-to-1 ratio, your broker will allow you to trade with $100 for every dollar you place in your account. With $100,000 in your hand, you have the potential to become a very profitable forex trader. But it's important to note that the global market is fickle, and forex investing is one of the riskier types of financial ventures. Riskiest. Invest in a rental property. Owning and managing a rental property, or two, can create a steady stream of income and set you up for an early retirement if you are able to buy in a profitable area. More and more of the country is pushing off buying their own home to rent. And you can capitalize on this trend by investing in an asset that's likely to increase in value while it's earning money. You can even hire a property management company to handle the midnight phone calls for you and limit your landlord status to collecting rent. Unfortunately, rental property management is not as easy as collecting a check every month and fixing an occasional broken sink. There are rules and regulations surrounding landlord-tenant relationships that you'll have to learn about in order to operate within the bounds of the law. For example, in most states, landlords forfeit the right to stop by their property to inspect it without at least 24 hours' notice. You'll also need to be prepared to deal with squatters, delinquent tenants, and the expensive eviction process should a tenant refuse to pay rent or leave. This doesn't even begin to cover some of the horror stories that rental property owners have experienced with delinquent tenants who choose to vandalize the property before being forced out. No matter which strategy and risk level is right for you, your first step should be to do plenty of research before you invest. Most people may think stocks and bonds are the only investment options, but if you're learning how to invest in commodities, you may know that they provide an option to diversify a portfolio. Though most people are familiar with buying physical gold or other precious metals, today's market offers a variety of options from exchange-traded funds, or ETFs, to futures contracts. Commodities are basic goods that can be substituted with other equivalent goods of the same variety. These include precious metals, such as gold and silver; energy, such as crude oil and natural gas; industrial metals, such as copper and tin; food products, including wheat and cattle. Commodity products become so homogeneous between suppliers that though there might be slight differences in quality, the products mainly differentiate on price. Most commodities are priced in dollars, which allows some of them to be used as a hedge by investors. Some commodities differentiate based on from where they're supplied, such as West Texas crude versus London Brent crude. Commodities also play into inflation as they are direct input costs for many industries and uses, such as steel for buildings and gas for cars. As the cost of commodities rise, consumers spend more money to buy the same amount of the commodity, leaving them with less to purchase other goods and services. Investing in commodities can be done through several options: exchange-traded funds, or ETFs, mutual funds, futures contracts, physical assets, the stock of companies heavily tied to that commodity. Each type of investment vehicle has different risks, transaction margin requirements, and contract parameters. Futures contracts require margin and carry additional risk compared to what you might find in an ETF. Additionally, futures-based products have what's known as backwardation and contango, where the current price may have a discount or premium relative to the expected spot price in the future. Figure out how much money you want to allocate to the investment and then determine how much of the investment you will be purchasing based on the price plus any fees associated with that particular commodity and investment vehicle. Keep in mind that leveraged products, such as futures or leveraged funds, will move more than a regularly traded index and won't need as much capital to achieve similar returns. However, because of the borrowing costs of leverage, they will provide lower returns on a comparable basis. Depending on the type of investment and vehicle you choose, you may be required to open a futures or stock account. Most major brokers allow the trading of stocks, ETFs, and mutual funds within the same account. Futures accounts will require additional setup and are not offered by all brokers. When purchasing physical assets, there are separate dealers who buy and sell commodities. Once you have the correct account set up with the broker, you can transact online, over the phone, or through one of their remote offices. Commodity ETFs, mutual funds, and commodity supplier companies all trade and act like regular stocks. Futures require a specific exercise date, as well as choosing between various sized lots. Physical commodity brokers may have different requirements that are different from broker to broker that are similar to purchasing any other physical good. Commodities offer a unique way to invest in assets other than stocks. Though prices on commodities can be relatively stable for long periods of time, technological advances like fracking for oil can cause quick changes in the price of a commodity. Additionally, commodities can be influenced by natural events and supply disruptions. Maybe you need to diversify your investments and lower your risk. Perhaps you're looking for a so-called safe haven investment to perform better when the rest of the market is down. Gold may be considered the best safe haven investment. Start with our guide to learn more about how you can include some gold in your portfolio. Like any other commodity, the price of gold is determined by supply and demand. Most of the world's gold comes from the hard rock mining, but it can also be produced using placer mining methods or as a byproduct from copper mining. China, Australia, and Russia are the largest producers of gold in the world. Gold's main use is for jewelry production, but it's also used in the aerospace industry, medicine, dentistry, and electronics. Governments and central banks are also buyers of gold. Currently, the U.S. is the largest gold holder, while Germany comes second and the International Monetary Fund is third. Private investors are also interested in buying gold and treat the purchase of gold as an investment. Why are private investors investing in gold? Instead of holding a cash position, you might buy gold when they expect a recession, geographical uncertainty, inflation, or a depreciation of currency. Sometimes investors hold it as insurance from a market decline. In the last 40 years, gold recorded significant gains from 1978 to 1980 and from 1999 to 2011. It struggled during the 90s and after 2011. Fears of inflation and recession led gold to its 1980 highs, while several events caused gold to trade higher after 1999. The September 11th attacks and the war in Iraq held the gold price higher until 2003. Insurance buying was behind gold's move higher going into the 2007 recession. It continued its uptrend as the market traded lower, with economic uncertainty as its main theme. Problems in Europe, a weaker U.S. dollar, concerns over economic recovery kept the gold price high until 2011. Gold has not always performed well. It struggled during the 90s due to a growing U.S. GDP, interest rate hikes in 1995, and a tight fiscal policy. After 2011, the strength of the U.S. dollar and economy hurt gold. The stock market broke out of a downtrend and turned in the uptrend, and investors were not as interested in owning gold as an insurance. Now you know a little more about gold and why people invest in it. Here's how you can start investing in gold. 1. Buy physical gold. You can get exposure to gold by purchasing gold jewelry, coins, or bullion. Gold bullion trades close to the price of gold, and it can refer to gold bullion bars or gold bullion coins. Bullion doesn't have any artistic value, which makes it different from jewelry or numismatic coins. To buy gold bullion, you have to pay a premium over the gold price, which can be in a range from 3% to 10%. You also have to use a vault or a bank deposit box to store it. You can buy physical gold online, in a jewelry store, or through another gold storefront. Before you purchase, make sure the price is fair, the gold is real and tested, and that you aren't paying a higher premium for collector's coins if you're just looking for pure gold. Be prepared to walk away if these standards can't be met, especially if an online store or physical storefront feels shady. Once you buy gold, you have to store it properly. You could store it at home, but security issues could arise from this approach. If you decide to purchase and keep it at home, make sure you have a proper safe and take the necessary measures to protect your assets. 2. Buy gold futures. Futures contracts are standardized contracts that take on organized exchanges. They allow a holder to buy or sell an underlying at a specified time in future and buy at the price from the futures contract. You'll need to open a brokerage account to get started. Here's how it works. A gold futures account at Chicago Mercantile Exchange covers 100 troy ounces. To trade it, you need to deposit an initial margin, which is a minimal amount necessary to open a position. Every day your position is going to be marked to market. That means if the price goes in your direction, you'll make a profit. If it goes against you, you'll lose money. If your account drops below maintenance margin, you will have to transfer money to your account to meet the amount of initial margin. Futures contracts are leveraged instruments. You need to only need your account balance to equal the initial margin, which is lower than the value of the whole contract. Most brokers do not have the delivery options, so the contract is settled in cash when it expires. The expiry is also a standardized feature of gold futures contracts, and investors can choose their time horizon while keeping standard expiration in mind. Later expiry contracts prices can be higher than the spot price and earlier expiry futures. When this is the case, we say that the market is in contango. On the other hand, when the spot price or the price of early expiring contracts are higher than the price of later expiring futures contracts, we are in a backwardation. If you are buying gold when the market is in a contango, you will also have to pay a premium for later expiry contracts. 3. Invest in gold ETFs. If you are not a fan of investing in gold futures, you can try gold ETFs. Instead of owning futures contracts and paying attention to maintenance margin, you can buy ETFs and get an exposure to gold. 4. Invest in gold mining companies. An investment in gold mining companies offer exposure to gold, but the exposure is sometimes limited. These companies carry operating risks, which can break a correlation to the gold price. Gold miners are at a risk of default, and their shares can trade lower in case of an operating problem with the company, regardless of the price of gold. You can diversify your investments and lower your risk with an investment in gold. There are many ways to add gold to your portfolio. If you have made it this far, feel free to like the video, subscribe, and watch my next video.